All right. So this week we had a lot of macroeconomic data, though I think that the most important indicator that came out was the PC price year over year. Now, the reason why we want to track it is because it came in at pretty much the lowest level since September of 2024. So we see here for April, it came in at 2.1%, the same levels it came in September of 2024. Now, the reason why I'm saying this is because back in September, we also had the first rate cut in over 4 years from the Fed. As we've seen, they have reduced their rates from 5.5% all the way to 5.25%. That was the first rate cut. Now the CME Fed Watch tool, as we see here, it's currently pricing in 2 additional rate holds in June as well as in July before we shall see our next rate cut in September. Now, I've made my case on this multiple times before, and I think it's one of the most important things right now to track. The reason why we want to analyze Fed's monetary policies, why we want to pay attention to what the Fed is doing, is because they have a very major impact on the markets. I believe that rate cuts aren't bullish for the markets. I believe that the environment leading up to rate cuts is. The reason why I'm saying this, as I've said many times before, but I feel like I cannot emphasize enough on this idea and its importance. The reason why I'm saying this is because a lot of people believe that rate cuts are bullish for the markets. I don't think that's the case. Rate cuts signal that the path that the economy is on isn't sustainable anymore. Therefore, the Fed needs to intervene, and they need to intervene through their monetary policies. That's why they reduce their rates, that's why they step away from their quantitative tightening measures, because the path that the economy is on isn't sustainable anymore. Therefore, they need to intervene. Now, when they have stable monetary policies, that's when the markets are actually bullish. And as we've seen throughout 2023 and all throughout 2024, when the Fed had stable monetary policies, we had, as we see here, 5.5% in rates, and the markets went up. Now remember, this is when a lot of people believed that the economy was falling into a recession, that this was actually a bear market rally that would precede the next leg down. That's how a lot of people felt because of high rates. But rates aren't what really drive market cycles. Liquidity and how much liquidity is introduced in the markets isn't actually what drives bull markets. But what actually drives bull markets or bear markets is the risk appetite of investors. That's what it all comes down to. The risk appetite of investors and how much risk are investors willing to take. Back in 2023, we've seen this stable macroeconomic environment where the Fed had stable monetary policies. They kept their rates at the same level for over 1 year, right? This leads to this period of economic certainty. Now, what this period of economic certainty leads to, and this stable macroeconomic environment where there was also a stable and resilient labor market, and inflation was relatively low. There was relatively high economic growth as reflected in the GDP. Therefore, that led to a stable macroeconomic environment as a whole. What that leads to is more investments because there's a higher risk appetite in the markets and the higher risk that investors are willing to take. And as we've seen, that leads to technological advancements, that leads to AI growth, and that leads to a lot of positive narratives. But it all comes down to risk appetite. There are endless narratives we can use, such as Goldilocks economy, AI, speculation, and so forth, that we can use to justify this rally. But I believe it all comes down to how much risk are investors willing to take in the markets, and essentially how they feel about the broader economy, about the broader markets, and so forth. Now, we've seen the same concept once again, but in the opposite way, playing out back in February and March and early April when the markets crashed. Now, what happened here was that we had a lot of uncertainty around monetary policies. We had a lot of uncertainty around tariffs, and that has led to this very aggressive market sell-off. Now remember, in this sell-off, no fundamentals have changed. So there were no fundamentals that have changed. There were still the same fundamentals. There was still the same economy. This move has been driven by speculation only. So there were no real fundamentals that have changed. At the time, the labor market was still resilient. We had pretty much the same monetary policies still in place. So there were no fundamental impacts. But the markets dumped regardless of that. And this is the reason why I always highlight that it's so important to have an objective analysis and an objective strategy that we stick to. Because we have periods like these where we actually want to step back and reflect on the broader market picture. We want to ask ourselves, has something fundamentally changed in the markets that would invalidate a certain bullish thesis or something along those lines? Well, no. There are no fundamentals that have changed here. So personally, I didn't understand why a lot of people have gotten so bearish at the range lows, why a lot of people have scaled out of their investments and of their spot holdings. But we'll get on that in just a couple of minutes. This week, we also had Nvidia earning reports, which came in very good, which was a blast. And Nvidia has beat on earnings and revenue as data center sales jump over 73%. Now, of course, I believe that focusing on Nvidia's earnings report isn't just about the company, but about the broader economic environment as a whole and about the AI sector. Now, a lot of people have been under the impression that AI was a bubble and that AI is what drove this bull market. Now remember, as I said earlier, there are endless narratives we can use to justify why this bull market has happened in the first place. A lot of people said that it was an AI bubble that is what drove this bull market, and it will burst eventually. Now, that's what we've seen, and as reflected in the P/E ratio of Nvidia, we see here that back in 2024 there was a pretty substantial bubble formed, with Nvidia's P/E ratio reaching levels of up to 200. Since then, however, the P/E ratio has been going down. And even though the stock's price has been also going up, the P/E ratio has been going down, suggesting that this was mainly a fundamental driven rally, not based on pure speculation. I say this because back in April, when a lot of people were scared, a lot of people were anxious about a potential recession and about tariff headlines, I saw this chart all over my feed indicating this correlation between Nvidia and Cisco, right? Basically, we had this blow off top back in the dot-com bubble of Cisco, then eventually the bubble burst and we had this crash. And a lot of people have highlighted the correlation between Nvidia and Cisco. One way, however, through which we can confirm that this wasn't a bubble was comparing the P/E ratios. Back in 99, when Cisco topped out, the P/E ratio came in close to 200, and Nvidia had a P/E ratio of 34 at the time. So not as immensely overvalued as Cisco was. But because we had a lot of recession fears, because there were a lot of fears in the broader market environment, we saw these charts, because that's how a lot of people farm engagement and how they get attention, by appealing to the primal emotions of people, right? This is also something that we have to keep in mind when we look on X. Most of the posts aren't genuine, so we want to take them with a grain of salt and look at these posts as an additional confluence to our own analysis, not use certain analysis as our analysis. We don't want to replace that. We want to use other people's analysis, other people's thoughts as a way to understand maybe the other side. I personally see that, especially on X, I see contrarian views to mine that would offer me a different viewpoint or a different perspective. Maybe there is something I've missed in my own analysis that I could learn by looking at what the other side is seeing. So I think that's how X should be used. A lot of people unfortunately use it to, replace their own analysis, and based on what other people are saying, that's how they make their investments, which I believe is a complete mistake. Blindly following others is a mistake as a whole, not only because that person might be mistaken, firstly, but secondly, because if he's truly mistaken and if he's doing a mistake, well, you lose money, but you also learn nothing. So when we do mistakes in the markets, we want to learn something. That's the bright side of things. And by adopting other people's mindset, we cannot do that. So moving on to another headline, which is very important. Trump is once again starting the tariff war. And I've seen a lot of people anxious about this, that Trump is re-announcing tariffs, that, we're seeing pretty much what happened back in February and back in March. A lot of people are really scared about this. But I always said that tariffs aren't bad, especially when they come from Trump. Trump has the tendency to make the art of the deal. He announces tariffs, then he rolls them back, and he eventually gets a deal, which is in favor of the US. That's what Trump does. And being anxious about this isn't a good choice, in my opinion. What we've also seen is how these tariffs get used by market makers to accumulate. Now, back in February and back in March and back in early April, what preceded and actually what triggered all of the liquidation cascades that happened was a tariff announcement by Trump. And this is where it gets really interesting. And you might say it's a conspiracy theory, but it's actually what helped me to identify every time the range highs, then take protective shorts, then once again, this is what has allowed me to keep accumulating even though the prices have gone a lot lower. This is also what helped me to remain level-headed and objective to my strategy and analysis. That's when a lot of people got scared. That's when a lot of people started to believe in the idea of a recession. But I didn't, because I identified this exact period where market makers accumulated. Therefore, I used it as an opportunity rather than risk. I didn't see it as a risk. I saw it as an opportunity to buy at cheap prices. That's what I've done. I made a post where I said that I had lowest cash positions since the 2022 bear market lows. Therefore, I made the decision to accumulate, and it ended up being a smart decision. One of the main factors I've used, one of the main indicators I've used in my analysis was this series of untapped lows that developed on the low timeframes. We see here each time there has been this series of untapped lows. Tariff announcement is what triggered it, and then we had this liquidation cascade. And I've made this argument many times before. Here we were back in early April, where I said that this was essentially a short-term pain for long-term gain scenario, where we had this short-term pain, we had this pullback along the way, but it would eventually lead up to a long-term gain, because that's how market makers have accumulated, by inducing fear in the markets with all of these tariff headlines, by creating uncertainty, by creating anxiety among market participants. And that's what they've done to shake out weak hands and position themselves for something much bigger over the coming months. Now remember, this is what I said back in early April, and here I made a post back in late March where there was this series of untapped lows developing. I've used it once again in real time, and of course it led to the liquidation cascade back in early April. Now this is why I think that tariffs aren't a bad thing for the markets, because Yes, there might be some market manipulation, as we'll get on in just a few minutes. There might be. Market makers, of course, manipulate markets to position themselves and use retail as a counterparty. They do it both at range lows, as you saw here, this is how they manage to accumulate, and they also do it at range highs, as we'll see in a couple of minutes. They'll use it once again to induce euphoria in the markets. So yeah, this is how I've positioned myself. This is what I identified, and this is also what helped me to remain level-headed once again. So yes, it was frustrating, it was painful, but at the end of the day, it was the right move to do. And now they're doing it once again. Prices are getting lower, and we have a narrative that is making a lot of people flip bearish. Narratives, once again, are something that lags the price action. The price action will always front run and will always precede the narratives. We can always use the price action to position ourselves accordingly. I have done that. I have used this short-term pain scenario for a long-term gain in order to position myself. This is how we can do it. And so we get on to our next argument, which is the VIX. I haven't done this, I haven't shared this thesis publicly yet, but I'll do it in one of my upcoming videos. Something interesting I've been tracking was the high time frame trend on the VIX and how it affects the broader market cycle. One thing we can use is the volatility index because it shows us how volatile are the markets. So we all know what the VIX shows us. It shows us the put minus call ratio. So it essentially shows us how many people are hedged, and the more they are hedged, the more volatile the markets will be. Something that we see here is this trend that tends to occur. Over the last couple of years, we've seen the VIX being in this downtrend, right? This is where the markets have topped out. Of course, here is where a lot of people are hedged. Therefore, that's where the bottoms in the markets tend to occur. Then we have this downtrend. More and more people are not hedged anymore. Of course, more and more people start to believe in the idea that the bull market will continue indefinitely. Therefore, the VIX goes down as the put to call ratio also goes down. But then something changes. We have this. We have this uptrend. Now, remember, this is where the bull market still is on, right? The bull market still continues, as we've seen. So the trend has shifted around May of 2024. That didn't mark the cycle top. So the bull market has continued. But this is where it gets interesting, because the volatility is going up while the bull market is continuing. But why? Well, I think it's because that's where we start entering a speculation territory. And the more the volatility index goes up, the more chances we have of a cycle top. Market makers want volatility to either accumulate or to distribute. As we've seen when we were in this bear market, the volatility index was going up because market makers need volatility in the markets in order to either accumulate or to distribute. Once again, it all comes down to liquidity and market makers having a counterparty to trade with. Now, I believe that since we've changed this high time frame trend, at some point we will see something major. So this uptrend will most likely continue over the coming months before we eventually have something massive like this, a global event that will lead up to the next bear market, right? And we've seen something very similar happening before every major event that took place in the last 3 decades. So there was, first of all, here back in 2015 and 2018, we had this downtrend, and what preceded the pandemic was actually this uptrend in the VIX, which started back in early 2018. All right, this is where we've seen this uptrend, and then we had the pandemic 2 years later. Once again, we had a very similar event happening back in the 2000s. We had this downtrend. What preceded the great financial crisis was actually this uptrend in the VIX. So we've seen this happening throughout history. Now there comes the question on whether we could be repeating a very similar event once again, where the high time frame trend has reversed. Market makers want more volatility as we near the cycle top. I believe so. I believe that market makers will continue to use the emotions of retail to have a counterparty to trade with. This is why I think that in the next couple of weeks and months, we'll have volatility increasing and headlines changing on a daily basis. Now, Trump can give us that. As we all know, he is the king of flip-flopping with headlines, with perspectives. And I think that we will see that. We'll see exactly that. Headlines changing on a daily basis, volatility increasing, and a lot of investors being anxious on what will happen next. But that will essentially give us a wall of worry in the markets, the last blow off top phase that precedes the actual cycle top. Now, the thing with emotions is we can sometimes have this cognitive dissonance where we are anxious and uncertain because we don't know what will happen next. There are headlines changing on a daily basis. Nothing is stable anymore. We can only speculate on what will happen. However, the prices are going higher. So we are both uncertain, but we don't want to miss out on the rally. So of course we have this tendency to become emotional and to FOMO back in. Now this is what usually happens at the last phase of a bull market. We have this cognitive dissonance that tends to occur in the markets that makes retail become emotional, which eventually leads up to a cycle top formation. As everyone FOMOs at the top, market makers distribute, and then we have a recession or a bear market and so forth, right? It usually ends like that. So this is my thesis. I'll share it in detail in one of my upcoming videos, so make sure you stay tuned for that as well. Now, I've shared this thesis for the first time in September of 2024. When Bitcoin was around $50,000, I said that in this irrational fear, uncertainty, and doubt on Bitcoin miners and other equities, it is the best time to increase the total portfolio risk. I use the argument that major institutional investors need to sell and they'll require a strong counterparty to do it. Therefore, they have used both time-based capitulation as well as price-based capitulation to shake everyone out. This is what I said back in September. This is where I first highlighted the thesis around an emotional gap, that they will create a significant shift in sentiment from the current levels of fear and anxiety to a state of full-blown euphoria, where those who have been panic selling will buy high once again. If we look at what happened to Bitcoin, this is where I made the post. So you can all see here, September 4th, it was right here where I made that post back in 2024. I said that from the levels of fear we were seeing here in this range, they would take the prices higher to distribute because they always need a counterparty to do it. And here's the interesting thing. When we were at these levels, a lot of people were capitulating, a lot of retail investors were increasing their cash positions, right? Their cash holdings, they were positioning themselves for lower prices. Because we all know at range lows, people tend to become emotional, tend to become anxious, and tend to, be scared that the prices could keep on going lower. Then what's interesting, and we'll see in just a couple of minutes what happened right now as well, we had this phase. Now this reversal was very interesting to track because this was mainly a disbelief phase. Now what the disbelief phase means is that people didn't really believe that that was the true reversal that would lead up to the long awaited, bounce and rally in the coming weeks. Even me, at the time, I was somewhat cautious around, that we could have seen a prolonged consolidation phase, and until we had clear bullish confirmations, there was no way to know whether we could have a continuation back to the downside and so forth. Now, I believe that the macro bottom was in here, but a move something like this could have happened before eventually we saw a bounce. That's what a lot of people believed at the time. And, it's normal since we have been in this environment of fear and anxiety. Here we had the yen carry trade crash, a lot of people believing that we would see a recession. Then we had this disbelief phase, so the prices were going higher, but there's also an ego side to this, because people need to acknowledge that they were wrong. Bears need to acknowledge that they were wrong on their thesis and that the markets are going higher and so forth. So it's kind of hard to do that, and it's kind of hard to acknowledge when you're wrong. So you want to stick to your bias for a little while before you announce that you were wrong. And this is especially true when we are in a public space, like me, for example. All right, so as I was saying, then there's also this ego side, especially when we're in the public space. When we are in the public space, like me, for example, people who share their perspectives and their thoughts publicly, it's especially hard to acknowledge when you're wrong, because there's also this in the back of our minds that, our thesis could be in play. What if, what if I say, that I was wrong here on my bearish thesis, then the prices drop? That's something that is always on the back of our minds, especially when we are sharing our perspectives publicly. But when we are investing, we want to detach ourselves from emotions, and we want to have clear and objective points of invalidation, right? That's what I always do. I have clear points of invalidation that I share. Once they get triggered, so as I was saying, there's this ego side attached to it. Then we have this phase where the prices are continuing to go up. However, the people who took profits here, or who took losses here actually, and increased their cash positions, now they're not buying because they're waiting for lower prices. They're waiting for a better entry point. But that's where this emotional gap thesis comes into play, because we have a very sudden shift in the markets, a very big, bluff top. Let's call it a wall of worry, because there's this wall of worry that is getting climbed with people being somewhat uncertain regarding the current state of the markets. People saying that we could be in the early stages of a bear market, that this might be a fake out, that this is not the true rally. So there are a lot of emotions involved, especially when we are not positioned ourselves accordingly. Then we get into the FOMO stage. Now the FOMO stage has this tendency that people start buying. Everyone acknowledges that they were wrong. Everyone who didn't call for higher acknowledges that they were wrong. Now is the time to buy, but at that point, unfortunately, it's too late for them. The distribution phase is already here. And this was the distribution phase, followed by this consolidation phase that eventually preceded this major pullback. This is how market makers operate. This is how market makers use retail as a counterparty, through emotions, through headlines, through narratives. And every time retail investors need to tie themselves to something. Unfortunately, a lot of retail investors do not have an objective analysis. A lot of people are biased, and that could also include me. I'm not saying that I'm unbiased or that I'm not making mistakes. Of course, I've done a lot of mistakes over the last couple of months, which I've highlighted publicly so you guys can see the exact mistakes I've done, because my my role here isn't to play the perfect trader, right? Because no one is perfect. No one is 100% right all of the time. My role here is to publicly share both my wins as well as my mistakes so you guys can learn from my personal experiences. Maybe there is something that you might have missed in your analysis that you can learn and see from me and from the confluences I analyze. This is also why I explain in such a detailed manner my thought process and the confluences I track, because I believe my role here is to help other people understand what I'm seeing, or help other people not do the mistakes that I've done. So that's my role here, and I've shared all of my mistakes I've done throughout this pullback, right? There were a lot of mistakes, especially involving altcoins. I have bought pretty early into the dip, and I ended up buying too high. Even though I sold back in December, I waited for a 30 to 40% pullback, but that wasn't enough, right? So there are some mistakes that I've done, but one of the most important things that I didn't do is use leverage. Using leverage is one of the most stupid things that we can ever do, right? Because as we've seen with the liquidation cascades, do you know why these liquidation cascades happen in the first place? It is because traders set their stop losses at these levels, right? With leverage positions and so forth. We have these liquidity levels that represent untapped lows that traders have where they set their stop losses. Now, a stop loss of a long position is equal with a forced sell order. So once it gets triggered by this liquidation cascade, which was triggered in the first place by a tariff announcement, then we have a bunch of forced sell orders, which represent, of course, the perfect counterparty for market makers that are trying to accumulate. And this has happened over and over and over again because of retail investors that use excessive leverage. This is why these liquidation cascades have happened in the first place. Do you think that if retail was in spot holdings, these liquidation cascades would have occurred? No. But they do because there are a whole lot of impatient investors, a whole lot of degens that are using excessive leverage. And that's something that we always want to avoid, because we cannot outperform the market in this way. And we've seen a very recent example of this with James, who didn't win, and he has been liquidated. It's official, he has been liquidated. He lost like 97 million in total. So 80 million in unrealized profits and 17 his margin, which is a very unfortunate event that is really a lesson for all of us. Lesson that leverage doesn't get us anywhere. We want to focus on our spot holdings and on the high time frame trend. Trading with excessive leverage, now I'm not against trading. Of course, we can trade when certain confluences and certain data points are triggered, but we don't want to overtrade, and we don't want especially to use excessive leverage. And we've seen these liquidation cascades happening over and over and over again, which allowed market makers to continue to accumulate and to use retail as a counterparty. Now, this was essentially the same pullback phase and the same phase of extreme fear and anxiety like we've seen back in August and September of 2024. This was pretty much the same. And since then, we have reversed, we have formed new all-time highs, and how the price has reversed is truly what's worth tracking. We had, instead of seeing deep pullbacks like these before any bounce to the upside once again, we had these consolidation phases that have preceded each of the moves up so far. So you see here, every time there has been a move up, it has been preceded by this shallow consolidation phase where everyone thought that we were going lower. Now, here's the interesting part. This was pretty much the same disbelief phase to the one we've seen back in October and early November of 2024. Pretty much the same disbelief phase of people believing that that wasn't the true rally, right? That wasn't the true reversal, and that we could go lower from then on. This was pretty much the same disbelief phase. So now there comes the question, could we have a similar emotional gap forming in the next couple of weeks? I believe so. This has been my thesis for many weeks now, because we have seen the same playbook once again: extreme fear, disbelief phase, because these shallow consolidation phases do not give sideliners the opportunity to entry lower. For example, I wait for the price to stabilize here, I wait for a deeper pullback, which doesn't come. Then the prices go higher. Once again, I wait for a deeper pullback, it doesn't come. I wait for a deeper pullback, it doesn't come. And this is how I find myself being on the wrong side of the trend, holding cash from all the way down here, all the way to here. And now I wait for another pullback. I hope for another pullback. There are a bunch of guys who are currently highlighting a lot of bearish scenarios, highlighting that we may be in a similar scenario to the one we've been back in 2021. So of course, people are still sidelined. After increasing their cash positions here, they didn't get to buy throughout this rally. Therefore, now they are being sidelined and they are still waiting for a correction to come. And this is exactly the moment where I believe an emotional gap is coming. Because after this pullback, whether we go lower from here or whether we do something like this, or we could have this consolidation phase continuing for a couple more days before we eventually have this move to the upside, I believe this move to the upside is coming. Because this is what will truly lead to that emotional gap, to the one we've seen back in November, which is this one. Because market makers want to distribute. And then we enter once again the FOMO phase. The phase where bears acknowledge, okay, I was wrong, and now is the time to buy. Now is the time to finally flip bullish once again. But at that point, it will be too late for them. Now this is why I have started to increase my cash positions from these levels. And I know it may seem counterintuitive. Well, if I'm expecting higher prices, how could I de-risk? Well, first of all, I have de-risked when we were at these levels. So when we were going up a couple of days ago, I publicly announced that I was de-risking. Now Bitcoin has went lower like this. Bitcoin miners have also gone pretty low. They are down 25 to 30% from the levels I sold them. Altcoins are down pretty substantially as well. That gives me a nice buying opportunity to reload at cheaper prices, right? And this is something I have highlighted publicly all over X and all over YouTube as well, with the exact confluences I tracked and so forth. So it's all public. You can check it out on your own. But what I wanted to emphasize is that with some of the profits I took, I'll buy once again when we reach specific ranges on Bitcoin and on miners and on altcoins as well. However, a pretty substantial portion of those profits will be invested into bonds, because I believe that diversifying early will be key in the next couple of weeks. Now, this is a strategy I'll do in the next couple of months. So it's not that I'm, selling Bitcoin to invest into bonds. It's not that deep, but instead it's just a natural rotation, right? When we were at these levels back in early April, I made a post where I said that I had the lowest cash position since the 2022 bear market lows, and I showed it a bunch of times. I think a lot of you already know what I'm talking about. That was because the risk of buying here after such a big pullback is pretty low, right? Buying after a pullback from a risk reward perspective is a good decision. That's why I bought here. That's why I had the lowest cash positions. This is where a lot of people got really anxious. I made the decision to buy. All right. But now, since the prices have gone a lot higher, so Bitcoin's price is up like 50% since, the risk of buying or the risk of being invested in the markets, of course, is higher. Therefore, I'm not willing to be invested fully anymore. So I want to have higher cash positions. That doesn't mean I'm bearish in any way on the markets, but it's just a natural rebalancing of my portfolio that I'm trying to make right now. And as I highlighted, in the next couple of weeks, I intend to gradually scale from my spot holdings on Bitcoin and on altcoins and on miners and other equities as well to buy bonds and money market funds and so forth in order to position myself once again for the next bear market, because this phase may bring a lot of gains, but it will also bring a lot of risks. Once we start this distribution phase, once altcoins finally start to outperform, that's also where a lot of risks will be in play. So I want to gradually scale from my spot holdings. I don't know when the top will be in. I think nobody does, especially when we're in price discovery. Nobody really knows when the top will be in. So I think that the best approach is to gradually scale out of the markets, gradually increase our cash exposure, and, gradually rotate out of risk assets in order to rotate into safe assets. Now I've done the exact opposite thing here in this dump. The thing is, I didn't know when we will bottom out. I didn't know when this reversal will come. I knew that it will come at some point, but I didn't know when. So because of that, I didn't try to time the bottom. I didn't try to long the bottom. I just accumulated. I just kept accumulating. I just kept using the same strategy over and over again, hedging a range highs, waiting for a dump, buying spot positions. Then once again, we saw a bounce, hedging a range highs, scaling out of my protective shorts, buying spot position. Over and over again. And, I've used multiple confluences, multiple theses around liquidation cascades, bearish confluences, open interest funding rates. But the concept behind that was actually very simple. Hedge a range highs, take protective shorts, wait for this dump, scale out of them, rotate back into spot holdings. It was very, very simple, right? And I used it back times and times again. Even here, this is where I used the same strategy and it eventually failed me, right? Because no system, no strategy can be applied, indefinitely. At some point, it will fail you. Any system, any strategy, at some point, it will fail you. So I waited for this moment. I waited for a clear invalidation of this bearish thesis, which was at the time this change of structure with a higher high. When we broke above the prior high, as I said, clear invalidation points. This was my clear invalidation point. I just took the loss and moved on, right? And I ended up accumulating when nobody else did. And I had some losses here, but who cares? Then I just scaled out of my protective shorts and I enjoyed the rest of this rally. And now I'm proud to say that I'm taking profits here, because do you know what taking profits here means? It means that you bought when nobody else did. That's what it means. It doesn't mean you're bearish. It doesn't mean you're, betting on a crash. It doesn't mean that. It means that you bought when nobody else did. So if you have profits, well, congrats, because it means that you bought when nobody else did. So now I want to show you something very interesting, which is the liquidation heat map, which is the total liquidations. We see here how many liquidations over the last 24 hours have been over 460 million, which is an incredible number. And also, James, who didn't win, has been fully liquidated, as I said earlier, which is a very big lesson for all of us. What leverage actually brings us, what investing with no plan, no strategy brings us. I personally believe it was all a marketing campaign, and that it was mostly a delta neutral trade, meaning that he had these long positions, but in the background he also had some short positions that he used to essentially have zero impact on his balance. But so that's what I believe I don't have any research on it. I don't know if it's true. I'm not going to enter this conspiracy theory, but certainly it was a great marketing campaign for a lot of the projects that he has promoted, and certainly this theory could be in play. But what we want to focus on here is not the idea behind what James Wynn did, but is behind his trading. And this is not how we should trade. This is not what we should do. Use excessive leverage in a very tight range, and then we just get liquidated. Now, another thing I've seen a lot of people covering is the outflows from ETFs. A lot of people have been really scared that we're seeing major ETF outflows right now. But as I always say, before we before we look at data, before we get scared, we want to look at what happened in the past and how the market has reacted from that data. What we see here, very interesting, since the ETFs have been launched back in January of 2024, mostly every local top and local bottom has coincided with some major inflows or outflows. We see here, for example, back in March of 2024, we had the biggest inflows, ETF inflows. That has coincided with local top. Then local bottom here, ETF outflows, local top. So over and over again, we see here major ETF outflows, local bottom. Major ETF inflows, local top. And this has happened over and over and over again. We see here back in December, for example, or back in November, major ETF inflows, everyone buying in, everyone being bullish on the markets. A lot of people using this as a narrative to justify their bullish thesis. But that's why I think that tracking data isn't so important as seeing how the market has historically reacted from that data. Here, for example, back in January, we had a lot of outflows from ETFs. And this has happened over and over again. So now that we're seeing outflows from ETFs, it might confirm us that we could see a local bottom in the next couple of days. And as I said earlier, I think we could be approaching the next leg up, which will lead to that emotional gap, as I explained earlier. Now, there's also this correlation between 2021 and what's currently happening right now. So seeing what happened back in 2021, we see here there was this dump, this correction, which was followed by a sweep of the highs, which eventually led to the bear market. So that's what we saw. And a lot of people are currently highlighting that we could be in a similar scenario once again. That's also why I think a lot of people are currently sidelined. As I explained earlier, a lot of people still have cash from these levels that they didn't buy with. They waited at each impulse up so far. They didn't have the chance to buy. They didn't have a deep pullback to buy. Now that they're finally seeing a deeper pullback, this is 8% correction so far. Now that they're finally seeing a deeper pullback, they also have a very strong narrative to justify it. And no, I'm not buying. We're finally seeing a deeper pullback, but no, I'm not buying because we could be in this scenario, in this 2021 sweep of the highs that precedes the bear market. And to all of the people that have highlighted this thesis, I'm not saying it's wrong, but let's look at some other confluences which happened back in 2021. A lot of people overlook the performance of altcoins and its implications on the broader market cycle. The altcoins tell a very interesting story about the risk appetite of investors. Altcoins outperform only when the risk appetite is very high. When the risk appetite is very high, that's usually where we see distribution phases as market makers use the very high risk appetite of retail investors in order to distribute. So it's very simple to understand. It's a very simple concept. What we saw back in 2021 when we had that sweep of the highs and that preceded the bear market, we had the total three forming a higher high because altcoins were outperforming Bitcoin, because there was a very high risk appetite. A lot of people were betting on altcoins. A lot of people, you know, took the risks to invest in these altcoins. Therefore, that was a distribution phase. Now, on the other side, Bitcoin has formed a new all-time high, and the total 3 is still down over 20% from the highs back in November. So the risk appetite is clearly not as high as it has used to be back in 2021. Therefore, I don't think that we could be in a similar scenario once again. And this is where I explained. This is not the euphoria phase that coincides with the actual distribution range. This is not the very high risk appetite market that market makers need in order to distribute. This is just, I believe, the beginning of our next blow off top and our final blow off top of this bull market. And I said this many times before on how I think this bull market is going to end. It's going to end in a big fashion. It's going to end in a blow off top in risk assets, making everyone FOMO once again, fueled by positive narratives such as the end of quantitative tightening, future rate cuts, a potential soft landing, and so forth, that will fuel the euphoria of investors. That's how the real cycle top will look like. Think about that. Now, moving on to another post I made on X. Of course, we had a drop in the open interest. Over 30,000 Bitcoins have been liquidated off the market in this move down. And this is something I highlighted many times before, because I think that these consolidation phases have two roles. First of all, shake out impatient hands, because there are people who sell, there are people who panic sell after a correction, and second of all, tempt over leveraged traders into blowing up their accounts, like we saw recently with an influencer who didn't win. So while most are glued to the 5-minute chart, the real edge right now is to zoom out, focus on the structure, and stay in control. These ranges are designed to test your discipline and patience. So in these ranges, whenever we feel uncertain on what's going to happen next, and as I said many times before in some of my prior videos, right now bulls have a good argument in saying that this range could be a very similar range to the one we've seen throughout this move up that has preceded each of the impulses up so far. So we could be in a similar scenario once again. Bears have a good argument in saying that we're forming bearish divergences on the technical indicators. So we see here the RSI has been forming bearish confluences, and while the price has gone higher, while we had this higher high in the price, the RSI has made a lower high, suggesting that this uptrend might be weakening. Now the last time we have seen this was here, but since this, the last time was actually all the way back in November, which has coincided with the start of the distribution phase. So bears have a good argument in saying that we could be seeing right now a deeper pullback, so something similar to this, before eventually seeing our next move up. So whenever both sides have a good argument, as I said in one of my latest posts on X, whenever both sides have a good argument, both tend to be convicted in their own bias. Therefore, they get wrecked. Both sides get wrecked. So before there is any real directional move from this range, we'll most likely have a ton of volatility in the upcoming days. Something similar to this before we eventually have the true directional move, whether it's up, like I believe so, which is my base case, or whether it's down. We shall see. Personally, once again, I think that the most likely outcome moving from here on out is to go up, due to the fact that we will form this emotional gap, and it will also fit very nicely with the broader market perspective and the broader market cycle leading up to the final distribution phase, before we eventually have that economic downturn and bear market that everyone has been so anxious about over the last couple of years. So with that, we move on to the next thing, which are funding rates. Now, funding rates are very interesting. Something I've been tracking on the funding rates heat map is the fact that Bitcoin has higher funding rates than all of altcoins. So altcoins have really low funding rates. Most are in, as you can see here, in negative territories, signaling that there are more shorts than longs. Therefore, and this is also a thesis I've highlighted before, is that we have the Bitcoin dominance. I've highlighted how it plays a role in shaping the broader market cycle. Throughout 2023 and 2024, we saw a lot of people screaming continuously for an alt season. Now, an alt season is the last distribution phase from the traditional asset, which in this case is Bitcoin, to risk assets, which are altcoins. So it is driven by a very high risk appetite. Now, as I mentioned earlier, how market makers use this very high risk appetite of retail investors in order to distribute. So an alt season is what coincides with the final distribution phase and the cycle top formation. So saying that Bitcoin has topped out for this cycle at like $30,000 back in 2023 or at $60,000, it's just nonsense. The first time I believed in the idea of an alt season was here, when Bitcoin has first reached the $100,000 to $110,000 range, and that's when I started to believe in the idea of an alt season. There were some clear bearish confluences forming, but after I saw the correction, how it developed, all of the liquidation cascades, all of the fear that emerged in the markets, and the Bitcoin dominance going higher, suggesting that there still isn't an extreme risk appetite of investors, I started to buy in once again and DCA all of the profits that I secured back in December. Now, I believe the Bitcoin dominance will play a major role for moving forward, because when we'll see the Bitcoin dominance going down, it will show us that the distribution phase is beginning. And when the Bitcoin dominance rolls over, it pretty much marks the beginning of the end. And that's how I've used the Bitcoin dominance to assess the broader market cycle. And of course, if you are an investor in altcoins, if you are investors in all of these projects, we can use the Bitcoin dominance as a way to predict when an alt season could happen and when it's the best time to position ourselves accordingly. But the main point is that these alt seasons and the outperformance of altcoins against Bitcoin is very short dated. For example, back in 2021, this was the biggest alt season so far, time-wise, which lasted about 4 months. Back in 2017, this alt season has lasted about 42 days. Now you might say that, okay, what about this? Here there were like 3 coins in the whole crypto market. So you don't really want to take that into account. Personally, I think the real alt season happened here. This was the real alt season back in 2017, which lasted about 42 days. So these alt seasons are very short dated, which is why we want to understand that altcoins represent short-term opportunities to make money, but they do not represent a long-term opportunity to make money. Cherry picking that one altcoin that will outperform Bitcoin in a durable fashion is very hard to do and is almost impossible to do. Therefore, we can use altcoins to make short-term profits, but we can never use them as a long-term reliable investment. Now, that's what a lot of people have failed to do throughout 2023 and 2024. They hoped, then they believed that altcoins normally outperform Bitcoin in a bull market, and unfortunately they were wrong. So the main takeaway here is that Bitcoin is the king of the crypto market, and when we make profits in risk assets, we want to secure those profits and then rotate them back into the assets that tend to bring long-term reliable profits. And the same thing applies with small caps against the traditional equities in the S&P 500. The same thing applies here with altcoins as well. Whenever we make, and the same thing also applies with money we make from leverage trades, for example. What a lot of people do is, they make some money from leverage positions or from risky investments or from options and so forth. Then they invest all of the money back in hoping that they're gonna make more money, but they eventually round trip all the gains and they lose all the profits. And that's the story of a lot of retail investors. So if you don't want to do that, then make sure you secure those profits. Maybe if you want to keep investing in risk assets, do it, but rotate the majority of your profits into long-term reliable assets. And that's how you can compound your investments. That's the only strategy you can use by investing in risk assets, where you're not going to lose all your money. Because at some point you will. No matter how good you are, if you're going to keep reinvesting all of the profits you make in the same risk assets, at some point you're gonna run trip all of those gains. So make sure you don't do that. So this is how I believe altcoins will perform moving forward. I think that altcoins are likely to outperform Bitcoin in the next couple of weeks because of this broader market environment in which I believe we're entering this risk-on period that the markets are approaching. Therefore, the most likely outcome moving forward is that altcoins will outperform. And I've made my case on this multiple times with the ETH to Bitcoin pair. And what has led to its underperformance over the last couple of years was actually the macroeconomic environment. We see here that, so basically what this pair shows us, this Ethereum to Bitcoin pair, is how risk assets have performed against the traditional assets over the last couple of years. And we have two other similar pairs, the Total 3 and Bitcoin pair, which shows us how the broader altcoins are performing against Bitcoin. And we also have the IWM to SPX pair, which shows us how small caps perform against the traditional equities in the S&P 500. But as a concept, both or all three show us how risk assets are performing against their traditional and safer peers. When we were back in 2020 and 2021 and liquidity was getting injected in the financial system, of course, risk assets were outperforming. And this also applies to small caps as well, because small caps are primed from a lot of fundamental levels, and their business models are primed for growth when they have access to cheap financing and low interest rates, right? So then the Fed has started to step away from their quantitative easing measures back in 2021, and then back in 2022 they have officially ended their quantitative easing measures. They started to raise rates in order to combat inflation. Now, interestingly enough, this is where the ETH to Bitcoin pair topped out. And since then, as you can see here, since then, the Fed has adopted their quantitative tightening measures, the ETH to Bitcoin pair bled. And Ethereum has massively underperformed Bitcoin over the last couple of years. But now, since we've seen at the beginning of this conference, we've started with the PCE price index reaching its lowest level since September of 2024 at 2.1%, which is exactly at Fed's target. We will see the Fed finally transitioning away from their quantitative tightening policies because they have no reason whatsoever other than these tariff uncertainties to keep their policies still intact, right? They have no reason to combat inflation anymore. Inflation has been officially defeated, and it's only a matter of time until the Fed finally declares their victory against inflation and until they finally step away from their quantitative tightening measures. When they'll do that, like we've seen back in 2019, when the Fed has stepped back from their quantitative tightening policies, as you see here, last cycle was a very similar one to the one we're seeing right now, where the Fed was in this quantitative tightening environment. They were reducing their balance sheet, as you see here, reflected in their total assets. the ETH to Bitcoin pair was bleeding, and right where the Fed ended their quantitative tightening policies, that's also where the ETH to Bitcoin pair bottomed out. And since then, altcoins outperformed. I believe that something really similar will happen once again when the Fed will finally transition away from their quantitative tightening policies. Because we will enter this period of risk on and irrationality where this rally will not be driven by fundamentals. So don't get me wrong, I don't think that new liquidity, quote unquote new liquidity that enters the markets will push the price of these risk assets higher. No. The speculation leading up to rate cuts and the end of quantitative tightening will be what actually drives the prices of these risk assets much higher. This is what drives them, speculation, not fundamentals. The idea that we'll see rate cuts and the end of quantitative tightening, the Fed finally declaring their victory against inflation, and everyone cheering, that quantitative tightening is over, that is what leads to a very high risk appetite in the markets and to risk assets finally outperforming and investors taking additional risk, seeking gains. So these are my perspectives right now on altcoins. This is how I think it should all end. And I always, in these weekly market wrap-ups, I always try to fit the latest data in how it fits in and correlates with the broader market perspective that I have and that I believe we're entering in, and the broader market environment that we're currently approaching. So that being said, this has been pretty much the weekly market wrap-up, and I hope you guys enjoyed it. If you find these sessions valuable, please make sure to spread the word, share the recording, and I'll see you guys in the next one. I wish you all an amazing weekend ahead, and I look forward to the next one. Stay tuned for some amazing spaces I have lined up on Sunday, so tomorrow, and a collab video with Cantonese Cat that I'm going to do tonight. So stay tuned for that, and stay tuned for a lot of other projects that I will soon release. I'm really excited for each one of them, so make sure you guys stay tuned for that as well. Have a lovely weekend, everyone, and I'll see you guys in the next one.